So hey y'all. Um, I am so excited to have y'all here. This is a larger crowd than I expected, but I'm happy everybody's here. Um, we are gonna be going over the basics of trading futures. I trade futures every day. Well, besides the weekend.
I'm in a trading webinar, baby.
I trade futures every day, and so this is kind of my baby, my bread and my butter. I love options, but one second. Somebody in the Discord was asking where the link was. But I love options, but futures is definitely my baby, and this is what I trade day in and day out. And so I thought it would be fitting for me to do a webinar explaining the basics so that y'all could get on the right foot. Like y'all at least know the basics so that you could move forward. And I can share some of the tools that I use and some of the tools I feel like you should be using to get into this industry. So let's start off with an introduction. So my name is Lauren, but my middle name is Lakira. So everybody calls me Lakira. I really like it because nobody ever used to call me my middle name. And so I enjoy the fact that I have forced y'all to call me Lakira because I would never get called Lakira. But my first name is Lauren. So Lauren Lakira. I have been trading for the past 5 years and I have been full time for it's been like a year and a half now. And I have made six figures. I've been able to make six figures over the past 2 years. I have a master's and a I have a bachelor's and a master's in biology. And originally that's the path that I thought I was going to go on, but after working for a year as a data analyst, I was like, hell no. Like this is not what I want to be. This is not where I want to be. And so I transitioned to trading full time after working for a year. And so that's a little bit about me. I still have a data analyst kind of head, or that's kind of how I think, but I'm a full-time trader now, and now I help women get into this industry. It's a passion of mine, helping women. So I would say this is like a passion project. I enjoy it very, very much. So that's a little bit about me. I am very warm and welcoming. So I know some people have told me it feels intimidating to message me, but message me. Like this is what this is for. I built this community so that we have like a group where we can ask questions and feel out the environment because trading is a very like kept secret, I feel like, especially among women, specifically Black women. And I feel like more of us need to be in this industry. And so if I can help us get into this industry, job well done on my part, it does my heart good. And so that's a little bit about me. So we're gonna get into the nitty-gritty of how this works. And so, how does trading work? So, at the basis of what we do, if we think the value of an asset is gonna go up, we buy. And if we think the value of an asset is going to go down, we sell. So, this is the root of everything. This is the thing that you keep in the back of your head every single time. If you think something is gonna go up in value, like if I think something, let's just say for instance, I have a bike and I think that the bike is going to go up in value, I buy the bike. If I think the bike is going to go down in value, I sell the bike. So that's basically how you think about this. It's kind of like it's a principle that we use more than we think about it. Like we use the principle of trading in other things, but this is basically how trading works. So what are futures? There are a bunch of different assets you can trade, or not assets. There's a bunch of different markets you can trade. There's the options market, there's futures, there's just regular stocks, and I'm missing one, Forex, and there's Forex. I started off initially with Forex and then I transitioned to futures because I just like it better. I prefer it. But futures are contracts. Futures contracts are agreements to buy or sell an asset at a predetermined price on a specific future date. These contracts can be used to hedge against price fluctuations, which I will definitely get into how we use them to hedge against price fluctuations or to speculate on the future movement on prices, which is what we do. And some of the assets you can trade are the Nasdaq 100, the S&P 500, crude oil, gold, and platinum, just to name a few. But at the basis of this, you just need to know what a futures contract is. You're basically getting in an agreement to buy or sell an asset at a predetermined price on a specific future date. So now what does this entail? Right? I love a good scenario. Like I am down for a good scenario. Whenever I teach my mentees, I try to use a scenario because I think that helps us understand it the best when we use a scenario. So let's say all of us came together. It's 65 of us in this group, right? Let's say all of us came together and we all put $1,000 in each, right? So 65, 66, including me, would mean that we put together $66,000 and we opened a flower shop because we was like, we want to sell flowers. That's gonna be our little pastime. That's gonna be our little hobby or whatever, right? So we own this flower shop together. So now we have to fund our flower shop, right? Because this ain't I mean, it is a passion project, but you still want to make some money. So we got to buy the flowers. Flowers are expensive, especially with Valentine's Day coming up. The worth of flowers is definitely going up. They put extra tax on these flowers because Valentine's Day is coming up. So, as flower shop owners, we say, okay, well, we need to make sure that we have a supply for Valentine's Day because on Valentine's Day, it is very likely that we are going to sell out of flowers because everybody's man is buying them flowers. They better be buying us flowers. And so we want to make sure we have stock for when Valentine's Day comes and everybody sells us out of flowers. So we find a supplier. We tell them we need them to provide us with a flower shipment for February 10th to be able to sell for Valentine's Day. The thing with flowers is they die after they've been cut. So we don't want them to bring them to us now. We don't want them today. We want them to bring it to us February 10th, right? So currently, the current price of roses, for example, is 10 cents per rose. That's what the supplier is telling us. They're saying today's price, if we were to buy these roses today, it would cost 10 cents per rose. And the minimum amount of roses that we can buy is 1,000 roses, right? And we all collectively come to an agreement that that's a cool price. We cool with that because per 1,000 roses, we would spend $100. That's cool. We gonna spend it. We gonna spend it, right? And so this is the current price that they're offering us today. If we were to get these roses today, this is the price they're offering us. But we don't want to buy the roses today. What is today? Today is, let's check, January 26th. If they deliver those roses today, they will be dead by Valentine's Day. So we don't want them right now, right? And so we get in a contract with them. We tell them, okay, we're going to pay you today's price. So we're going to pay you $100 for the 1,000 roses, but don't deliver them today, please. Deliver them on February 10th because I don't want no dead roses, right? And so this is where a futures contract comes in. We reserve the roses for $100. We tell them we gonna pay you. Your money good. We're gonna pay you, but they won't be delivered till February 10th. We don't bring them to this flower shop until February 10th. So we already agreed that futures contracts are agreements to buy or sell an asset at a predetermined price on a specific future date, right? So, in this agreement to buy these flowers, we have said that we agree to buy the roses for 10 cents per rose on February 10th. So, we technically just entered into a futures contract. We locked in today's price because we don't know. Like, for instance, let's say we want to buy the flowers on February 10th, right? Let's say that we procrastinated, we waited, we
And the
didn't actually reserve the price that we were supposed to, we didn't do our due diligence and reserve them earlier. What the supplier could do is say, okay, well, the worth of these flowers, when we go to buy them, like February 10th, they could say, oh, these flowers are now 50 cents a rose. Like it's now 50 cents a rose. And because we own our flower shop, we would have to technically pay that because we need flowers for Valentine's Day. So by getting into this futures contract, it saves us money because if we think that the worth of the flowers is going to increase in the next 2 weeks before Valentine's Day, we probably need to buy some flowers now and get in this contract right now so that we don't have to face the reality of having to spend 50 cents per rose when we could have got them for 10 cents per rose 2 weeks ago. So that's why we're getting into this contract with our supplier. We want today's price, but we don't want them till 2 weeks from now, basically. Why is this valuable? Did I switch my slides? Why is this valuable? So basically, if we lock in the price, like if we say, okay, we are going to spend 10 cents per rose today we gonna pay you your money. We got in this contract. Don't deliver them till February 10th. That saves us in the long run. Number one, we don't got to think about roses. We don't got to think about where we getting our roses from. Our supply is already guaranteed. Our flowers already guaranteed, and it allows us to sell it for more. So whereas we got the flowers at 10 cents a rose, we may sell them for $1 a rose, right? So we make 90 cents a profit. If we wait and the value of the roses increases and we got to buy them for 50 cents a rose and we sell them for $1 a rose, we only get 50 cents worth of profit, you know? So a lot of times businesses use these contracts, like these are real life contracts. Businesses use these contracts to protect them in the long term from having to spend more on something just because the value of something increased. So I think a lot of times we think of futures contracts in trading, just in trading terms, but these are real contracts. Like before this was a trading thing, these were real things that businesses did to secure their products at the value they were. So this is considered hedging. I don't know anybody who uses hedging in real life. So, so don't ask me. But this is considered hedging. This strategy is considered hedging where businesses will secure the price of something today for something that they want delivered in the future, just so that they don't have to worry about the increase in price. They don't have to worry about what's happening in the next 2 weeks. We don't got to think about what the flower's gonna be worth in the next 2 weeks. We told them we done paid you the $100. Make sure our flower's here on February 10th. If not, we're gonna have some problems, right? So, what if we didn't own a flower shop? Let's step away from the flower shop. What if we didn't? So, we don't have a flower shop. Y'all didn't want to own a flower shop with me. Y'all said, we not gonna give you no $1,000 to go into no flower shop because you know what's gonna happen? You're gonna lose all our money. That's what y'all said. So, I'm in this by myself. So, I don't own this flower shop. We don't own a flower shop, but I still want to make some money. Who don't want to make a coin or two? So I still find a supplier. I'm like, I'm gonna figure it out. Like I'm gonna do this some way. So I find a supplier and I use the same stipulations as before, right? So I tell them, I need you to provide me with a flower shipment for February 10th because I'm gonna make some money on these flowers some way. Flower shop or not, I'm gonna make some money. So the roses cost 10 cents per rose. Same thing. The minimum order quantity is 1,000 roses, right? And so per 1,000 roses, we would spend $100. Cool. Right? Well, I would spend $100. Y'all not with me. Y'all fake. So I say, okay, this is the current price they offer me. Fine. I'll buy the 1,000 roses for $100. I get them that money. But I don't got nothing to do with these roses because I don't have a flower shop. I don't have nowhere to sell the roses from. You know, so it's like I gotta figure out what to do with these roses. It's a steal of a deal, mind you. Steal of a deal. But I don't have a flower shop to sell the roses from. So what am I gonna do? So let's say, right, I know the value of these roses is going to increase, right? So I know they deliver these roses to me February 10th. If I hold onto the roses until maybe February 12th, maybe I could find a flower shop that's willing to buy these roses from me for maybe 50 cents, 50 cents a rose, right? So I don't have to worry about selling the roses. I just need to find a flower shop I could get this off my hand. They're gonna pay a premium price because the worth of roses has increased. It's close to Valentine's Day. Like you can't pay me 10 cents a rose. You gotta pay me a little more than that. So I sell the roses to them. I find a flower shop. They say we really need these roses. You know, we need a shipment on time because they didn't do what we were supposed to do. And so I sell them for 50 cents a rose for a minimum of 1,000 roses. And I tell them, I'll have it on your doorstep on February 11th. Okay. And so they would pay a total of $500. So I found a supplier to provide me with the roses for $100. So I got 1,000 roses for $100. And they're going to pay me $500 for the roses. Right. So I would have a profit difference of $400. So I would have just made $400. But I didn't sell the roses. I don't have to find a bunch of different people to buy these roses from me. I just made profit off of being the middleman between two different people. Cool, right? So a futures contract is an agreement to buy or sell an asset at a predetermined price on a specific future date. They made an agreement with me to buy the roses for $500 on February 11th. So they technically just made a futures contract agreement with me. Great. We love that. I love the fact that I just made $400. I didn't have to sell the roses myself. I didn't want to be in front of my house selling roses anyway. So this is speculation, right? This is a scenario where I just want to profit off of the increase and decrease in the value of roses. I don't actually want the roses. I really don't care about the roses. I just know that currently I could get 1,000 roses for $100, and I could sell those roses for $500 and make a profit of $400. That's all I want to do. I just want to profit off the increase and decrease. I don't care nothing about them roses, right? So that's speculation. That's what we do as traders. We don't care nothing about what we trade in. We don't care about it. I don't care. I just want to profit when it increase and decrease. That's all I care about, right? So what if I wasn't as resourceful? What if I wasn't resourceful and able to find somebody to buy these roses from me? These 1,000 roses that I have, like let's say they deliver it to me on February 10th, and I'm sitting there like, I don't really got nobody who's willing to buy 1,000 roses. Okay, what do I do? That is where your broker comes in. So, brokers act as the middleman between buyers and sellers in the futures market, right? So they maintain the marketplace where traders can buy and sell orders for futures contracts. So if I was looking to sell the flowers at a fixed price, right? So I want to sell these flowers for 50 cents. Even though I bought them for 10 cents, I want to sell them for 15 cents. The broker will connect me with a buyer who agrees to that price. So I didn't have to find the flowers. I didn't have to find somebody to buy the flowers. They did it for me. They did all the hard work. I just had to provide the flowers. So, so once I decide to sell a futures contract for my flowers, right? I told them, all right, I got these flowers, get them up off my hands. The broker executes my trade on the exchange, and they ensure everything's working the way that it should. They make sure that everything's handled. All I do is tell them, okay, I got 1,000 roses. I need y'all to get rid of them. And they do that for me, right? So let's do a final scenario. I know y'all don't want to talk about roses all day. Y'all came to talk about trading. So let's do a final scenario, right? I bought 1,000 roses for 10 cents each, which cost me a total of $100, right? My goal is to sell these roses for 50 cents each so they pay $500, right? My broker is going to find that person to buy them up off of me. I don't have to find the person to buy them from me. My broker will. So what will happen is the revenue that I would get once my broker finds somebody to buy the flowers is $500. The cost was $100. And so I profit the difference, which would be $400 from not having to do anything, from the comfort of my home. I basically called them up and I was like, hey, I have 1,000 roses. I need y'all to find somebody. They find somebody to buy the roses up off of me. I make the $400 and I had to worry about selling not a thing. Okay. So let's talk about the best futures brokers, because I think this is a perfect segue into this, right? So a lot of times I think we don't think of futures as an exchange between a buyer and a seller. But for every futures contract that you buy, there is somebody on the opposing side of that selling, right? And so these are the best brokers to trade futures with. There's Tradeovate. That's a broker that I use to trade futures. Great reviews, low commissions. I don't have nothing but good reviews for them. There's also TradeStation. I know some of my colleagues in the trading community also use TradeStation. And then there's Interactive Brokers. So if you are not from America, you can use Interactive Brokers. They take non-US clients. Even if you are from America, you could use Interactive Brokers as well if you would like. So enough about flowers. Let's stop talking about them. Let's talk about what I actually trade. I don't trade flowers, y'all. This was just a hypothetical scenario to get you to understand how a futures contract works with something that we all understand, okay? But I don't actually trade flowers. I don't think you can trade flowers, right? So I trade the NASDAQ 100, also known as NQ. So you'll hear me say I'm trading NQ. I made this money off of NQ. That's what I trade every day. I don't switch stocks. I don't jump from one to the other. I trade the exact same thing every single day. So what is NQ? Futures contracts. Futures contracts based on the NASDAQ 100. The NASDAQ 100 tracks the 100 major tech and non-financial companies, right? And so you'll hear about NAS 100 or NASDAQ or so, like this is something that you could actually invest in for retirement purposes, right? It tracks a lot of the stocks like Apple, Microsoft, Tesla, like a lot of the big tech companies are within the NASDAQ 100. So basically, they just take all of them and lump them into one thing and put them on one chart so you could trade them off of one chart, right? So each contract's value, the value of a contract of NASDAQ, remember, when we was talking about the flowers, the value of the contract when I was trying to buy the flowers from the supplier was $100. The value of the contract when they were trying to buy it from me was $500. So let's think of value of contracts, right? Each contract's value in is the Nasdaq 100's price. So whatever the price of it is. So let's say the Nasdaq 100's price is worth $15,000. Currently, it's at $15,000. Multiply that by $20. So if you wanted to buy one contract of Nasdaq 100, technically, technically, it's worth $300,000. Nobody's coming up with that money. So don't come off saying you don't got $300,000. You can't invest in the stock market. Nobody's coming up with $300,000. That's just what the worth of the contract is, right? So why do I trade NQ? It's high liquidity and high volatility. So I can get good moves in the asset, meaning the asset can go up really fast and go down really fast. So I'm able to catch real quick moves in the market. I'm a scalper. I like to be in my trades for under 10 minutes. Anything over 10 minutes, too long, take me out of there, right? And so I love NQ for that. You get a lot of good moves throughout the day. Then there's 23/5 market access, which for me is really flexible and really good for most. So it closes from 5 p.m. to 6 p.m. Eastern Standard Time, right? Every day, Monday to Friday, and then it's closed on weekends. Um, I love futures, and this is another part of the reason why I love futures. When I was working full time, futures allowed me to trade from 4 to 7 a.m. before I went to work. Okay. So if you work full time, futures is great because you can trade it after work. I wouldn't recommend it, but you can trade it after work or you can trade it before work. Depending on how your schedule is, depending on what your preference is, it's very flexible to you. Whereas when you're trading options, options is only open, I think, from 9:30 to 5. My time may be off. I know it opens at 9:30. So if you work a full 9 to 5, you won't be able to actively trade options because the market isn't open during the hours when you should be trading. So that's part of the reason why I love futures. They give you a whole lot of time flexibility and there's also great leverage. So this is part of the reason why I was telling you, like, just because the contract is worth $300,000 doesn't mean you need to have that in your account. A lot of times you can trade large positions with small upfront capital, which is technically called trading on margin. And so you could trade with as little as $5,000 for a $300,000 contract, you know, and sometimes even less than that. And I'm gonna get into how you could trade with less than that, but just know that you can control a large position with a small upfront investment. So it's a lot easier, in my experience, to get into as opposed to an options because options, they do require a larger upfront investment for you to see any significant gains. So the NASDAQ 100, right? Futures contracts are agreements to buy and sell an asset like the NASDAQ 100 at a predetermined price on a specific futures date. I will repeat this till I am black and blue, right? So scenario, let's talk about an example. You expect the value of the NASDAQ 100 index to increase, right? You, based on your parameters, based on, the things that you know, based on your strategy, based on your predictions, whatever, it may just be your spirit. Your spirit may have said that you feel like the price is going to increase. Whatever it is, you enter into the futures contract for 15,000 today, right? The index is at 15,000 today. And you think that the contract is going to increase, like the value of the contract is going to increase, so you buy it. Why not? So if the index's value rises to 15,050 before the contract expires, you profit. And I put 15,050, but realistically speaking, as long as it reaches above 15,000, you profit. It could be 15,001, 15,050 cents. Like anything above 15,000, you technically profit, right? But let's just use the scenario of it being at 15,050. So each contract's value, so the contract's value changed. We went from 15,000, the contract was initially 15,000 to 15,050. That's what NASDAQ has switched to. The value of the asset has increased. So that's a $50 difference in the NASDAQ 100. But that doesn't mean you made $50. It's a little bit more tricky than that. There's a little bit more math to it, right? So for profit, each dollar change in the NASDAQ 100 earns you $20, right? So that's why I say it's a little bit more tricky to that. I'll explain about it a little bit more as we get throughout this presentation a little further. But basically, just know every time the NASDAQ 100 goes up a dollar, that earns you $20. So if it goes up $50, that's not $50 for you. That's more than $50 for you. So you would multiply the $50 that the market went up by 20, because every dollar that the market goes up, you earn $20 for an overall profit of $1,000, basically. So you would have made $1,000 profit. Whatever hunch you had, whatever inkling you had, whatever it was that made you buy the NASDAQ 100 at 15,000, you were correct. You were right. And you made some money. Now, what if the value falls? Because we always like to talk about making money. We don't talk about losing money. We don't like to talk about losing money. If the value falls to $14,950, your loss is calculated in the same way. You thought it was going up, but it didn't. It didn't. Sometimes it's a plethora of reasons why you could be wrong. Some of those reasons are like the market just went against you, which some days that happens. You did everything right. You executed your strategy right, but the market just went against you. Or you could have broken one of your trading rules, and as a result, you lost money. So those are the two reasons you could lose money in the market. Whatever the reason was, you just lost money. So it fell to 14,950. So it was a 50-point decrease. So the $50 multiplied by 20, so you had a $1,000 loss. So just as easy as it is to make money, you could lose money the same way. So this is what I was talking about. Like, I'll explain it later. It's ticks and points. So the market moves in ticks and points. I feel like, sometimes as beginners, we look at the chart and we be like, well, I'm not a beginner, but y'all look at the chart and y'all be like, that just moved $1 or that just moved 50 cents. But it's a terminology for that. Like, there's terms for that. So there's ticks and there's points. So what is a tick? A tick is the smallest movement in NQ futures, right? NASDAQ futures. So one tick is 25 cents that the market moved. So when you go on the chart and you look, it moves in 25 cents increments, meaning the market can't go up 10 cents. Not NQ at least. NQ can't go up 10 cents. NQ can't go up 15 cents. Anytime it goes up, it has to go up in a 25-cent increment, right? And every time it goes up 25 cents, that's worth $5. Or if it goes down 25 cents, that's worth $5, right? So every 25-cent movement on the chart is $5 for you. What is a point? So a point is a larger price movement that's made up of 4 ticks. So 4 ticks are in 1 point. 1 point is $1 worth of movement on the NASDAQ, and that is worth $20. So every time the NASDAQ moves up $1, that's $20 for you. And every time it goes down $1, that's $20 you lost, right? And so that's kind of how it works. So if the price moves from 15,000 to 15,001, so there was a 1 point movement, for a tick movement, that's $20 worth of profit and loss, right? Or if the price moves from 15,000 to 15,025, that's 1 tick, which is $5 profit and loss. So that's how the market moves. Ticks and points. That's the increments that we move at, is ticks and points. So this is one of the things that I would say, if you don't understand, you should put a little bit more time into, because you do want to know how much money you are risking when you get into a trade. You want to know how much money you're risking and how much money you could gain. So ticks and points, knowing how much the value is, knowing what the worth is, very important. Very, very important. So let's look at a chart. Why not, right? So let's be reminded, 1 tick is a 25-cent movement and it's worth $5. 1 point is a dollar movement and it's worth $20, right? So this is the chart. So I took a picture of my TradingView chart. So this is basically what I look at every time I go to trade. You can see the value of NQ on the side here. So you can see kind of like the increments, right? So if NQ is at 22,000 and moves to 22,010, so 22,000 is right here, right? If we move to 22,010, that's a 10-point move. We just moved up 10 points, or a 40 tick move, right? So if we bought a contract predicting that the price of NQ would go up or the value of NQ would go up, and it did, right? It did move to 2210, we would make $200. We would make a profit of $200 because we were correct, right? And so it doesn't just move up in random increments. Like there is a set way that NQ moves, and a set value that is assigned to those moves that NQ does. So, but what if I didn't have $5,000, $10,000, $15,000 to start? Like I got $200. Take it or leave it. Like what if I wanted to start a small account, right? There is micro NASDAQ 100, meaning you could trade the same thing for cheaper. Who don't love a steal of a deal, right? So micro NQ is a smaller version of NQ futures, and it's still based on the NASDAQ 100, right? It's designed for smaller accounts or for traders managing lower risk, right? So an MNQ contract, that's what we call it, MNQ, is 1/10 of the size of NQ. So if NQ is worth 300,000, MNQ is worth 30,000. So it's 1/10 of the value. That 1/10 translates into everything else, right? So one tick is worth is a 25-cent movement, still a 25-cent movement. When you're trading NQ, whether you're trading MNQ or NQ, a tick is 25 cents of movement. Instead of it being worth $5, it's now worth 50 cents. So we would only make 50 cents if it moves up a tick instead of $5. But if it goes down a tick, instead of losing $5, we would only lose 50 cents, right? Or 1 point. It's still a dollar, still a dollar. But instead of losing $20, we would lose $2. Much better, much easier on the heart, especially for beginners. Because I will say, trading is one of those things you want to ease your way in. You do not want to jump off the cliff because you will fall hard. You will fall real hard. So I like MNQ, especially for beginners, because it's lower margin, easier to get into. It's good for testing your strategy, playing around with it, getting yourself comfortable. Because if you just jump off the cliff into NQ, you will fall and you will learn to trade MNQ until you get it right. Right? And so if you're a beginner and you do not you're trying to test the water. You're just trying to see if this for you. If you want to really be a trader for real, start with MNQ. Start here. I still trade MNQ. Let me tell you what I do, right? So I trade a lot of size. I've been doing this for a while and I trade a lot of size. We know that MNQ is 1/10 of the size of NQ, right? Because I am so um used to trading MNQ because that's what I started, I stuck to it. So let's say that I want to risk $2,500, and to risk $2,500 on a trade, I need to buy 9 NQ contracts. What I do is instead of buying 9 NQ contracts, I buy 90 MNQ contracts. So yeah, that's kind of how I do it. I haven't switched from MNQ to NQ. I just prefer it. It's my preference. I get bullied in the trading industry because of it, but I really don't care. I don't care. Trading is a thing, it's individualized. Everybody gets to trade the way that they feel comfortable. And that's what I like to do. It's the same risk. So I'm still risking technically 9 contracts of NQ. I'm just doing it on MNQ, and that's okay. So comparing NQ versus MNQ, I had ChatGPT do this for me, right? So NQ, full size contract, $20 per point. MNQ is 1/10 of NQ and it's $2 per point, right? The tick value, NQ is $5 per tick, MNQ is 50 cents per tick. NQ has higher leverage and higher risk, but with the higher risk is a higher reward. MNQ is lower leverage and reduced risk. So lower risk, but also lower reward in some ways. Margin, NQ requires more in your trading account. You probably, if you want to trade NQ, you probably should be starting with an account of $5,000 minimum. If you want to trade MNQ, you could start with an account as little as $500. I don't recommend you go in any smaller than $500. You can, not a recommendation though. So it's lower barrier of entry. NQ is more for advanced traders and larger accounts, and MNQ is better for beginners and smaller accounts, or if you just prefer to do it because you became comfortable with it, like me. So, like I talked about a whole lot, right? How do we predict where the price is going to go? How do we predict where the market is going to go? We talked about, okay, if the market goes up and we predicted that it would go up, we would make some money. We talked about, okay, if the market goes down and we predicted that the market would go down, we would make some money. But how do we know if the market's going to go up or down, right? You need a trading strategy. You need a trading strategy. You cannot just do this blind. You cannot just jump off the cliff and just hop into trading without having an actual strategy. And when I say a strategy, like when you get on the charts, you need to know what you're doing, what you're looking for, what things you need to see to predict that the market is going up or down. My strategy is supply and demand, and that'll always be my recommendation. I think it's the best for beginners to understand. My strategy is very simple. It's like maybe 4 steps. Um, and I love it that way. When you're looking for a strategy, this is my recommendation as well. Do not use a strategy that has a million steps because it will make it harder for you to follow your rules. It will make it harder for you to execute. And in the long run, it hurts your profit and loss statements, right? You need something simple, especially if you're a beginner and you're just getting into this. You need something simple, straight to the point. Couple things you need to look for and you're in a trade, right? And so supply and demand, let me just explain the basis of what it is, right? And so if, for instance, let's talk about Valentine's Day and flowers. Why not, right? So let's say a supplier has 50,000 flowers, right? And they're trying to get it off their hands. But only like he only have enough people to buy maybe 4,000 of those flowers. Like he only have 4,000 people willing to buy flower. He only have people willing to buy 4,000 worth of the 50,000, right? Well, he don't have a lot of demand for what he want. Like not a lot of people want it. He have a large supply, but he don't have a lot of demand for it, right? And so the price of it's going to decrease. The value of those flowers is going to decrease because he don't have a lot of people who want to buy it. He don't have a lot of people interested in them flowers, right? So he gonna have to decrease the price so that he can get it off his shelf, right? And vice versa. Let's say he had 10,000 flowers, but he got people interested in buying $50,000 flowers from him, but he only got 10,000. He gonna have to increase the price because more people are interested in what he got, but he don't have a lot of it to give. So the price is gonna go up because the value of it's worth more because people are willing to pay more because they need those flowers, right? And so that's my strategy when I'm trading the market. I am just looking for areas of supply and demand where the market is showing me that there's a lot of supply or there's a lot of demand, and I'm using those hints to take trades. And based on that, entering with the bias of whether I think the market is going to go up or down. So that's how supply and demand works. It's a universal concept. A lot of people use it in the trading industry, and it's my recommendation. If you need a simple strategy, my recommendation is to go the supply and demand route. Real simple, real easy, straight to the point. And so that is basically a trading strategy that you can use. There are a bunch of others like support and resistance, trend lines, candlestick patterns, ICT. There's a bunch of other different strategies you can use. And you can find a bunch of content about strategies on YouTube. But my recommendation for you, if you want a simple strategy, is supply and demand. Okay. So let's talk about some tools you need to start trading. So I told you what futures were, basically.
Good,
Talked
you
about
good.
what futures are. And I explained to you, like, how do we estimate the value? Basically, some of the back end, excuse me, some of the back end information. Now let's talk about some of the tools that you will need to actually get into trading, right? So first things first, you need TradingView. This is like I don't want to call it the Bible. I can't like insult the Bible like that. But in some ways, I think for most traders, this is like the holy grail. Like you need TradingView. This is where you're going to look at the charts. This is where you're going to look at these different assets. This is where you're going to mark up the charts on to see whether you think the market's going to increase or decrease. This is where you're going to do all of that at. Okay. And so TradingView is definitely a must have. In my opinion, if you're learning from me, you're going to have TradingView. Any mentee come through me, they have TradingView. Okay. The next thing, you need a broker. I gave you the 3 brokers that you could use. You could use Tradeovate, TradeStation, or Interactive Brokers. You could pick between the 3. There are others out there. I just haven't vetted them to tell you that they're safe to trade with. But these 3 I know for sure are good to start trading with. Like, they're okay. They won't hold your money and not give you your money. You will get your money, okay? You will also need a backtesting software. So what is backtesting? Backtesting is basically where you look at you look at the data that happened before. So prehistoric data, I don't know if that's the right word for it. You basically go back in time to see if the strategy that you're using would have worked in that time. I tell all my mentees to backtest. Backtesting is the easiest way to get comfortable with the strategy before you start risking money. Okay, because you can basically simulate the trades when you're backtesting as if you were really testing and see how the strategy would perform and see how you would perform when you're actually trading. So if you are trying to figure out if a strategy is for you, if you are trying to just, you know, play around in the waters, see how trading works, you need to be backtesting. That's like the first step, backtesting. So the 2 backtesting softwares that I'd recommend, FX Replay. FX Replay used to be my holy grail. Like, it used to be the only thing that I recommend. But recently I have been made aware of TradeZella. TradeZella is cool because not only can you backtest on TradeZella, you can also journal your trades and keep track of the trades that you're actually taking in real time. And so it is a little bit more expensive than FX Replay, but it does provide you with a little bit more than FX Replay does. So, you know, weighing the pros and the cons, but you need to be backtesting. If you're trying to get into this industry, you're trying to get comfortable with your strategy, you're trying to be profitable in the long run, you need to be backtesting. Then there's prop firms. So you have 2 options when you're getting into the industry as far as when you are ready to start trading for real. You can fund a personal account. So let's say you have $500-$600 you're willing to invest. You can start with $500-$600 in a personal account and trade that. Okay. Or there are prop firms. Prop firms are companies that will tell you, okay, you can pay to take an evaluation, and based on that evaluation that you take, if you pass, like if you meet the standards that we want you to, we will provide you with funding. Okay. And so typically with Top Step, I think the evaluation costs $50 to take an evaluation for a $50,000 account. If you pass the evaluation, if you are satisfactory in the evaluation, they'll give you a $50,000 account to trade with. And you can withdraw profits from that account. And so there's 2 different ways to use. There's 2 different routes you could go. I trade primarily personal funds, but I also started in a different time. So when I started trading 5 years ago, I've been trading futures, I want to say for 2, 3 years now. When I initially started trading, there was not prop firms, right? Or they weren't as popular. They weren't like a common thing. And so I just used my personal funds, like they weren't popular like they are now. But now I think prop firms are a lot better for beginners, or a lot easier for beginners to get into. Let me not say better, but they're a lot easier for beginners to get into because of the profit, like the cost of entry, basically, because you could pay $50 for a Top Step account, and I think the activation fee is $150. So all in for a $50,000 account, you would pay $250. Not 250, $200, which fairly cheap, like fairly cheap for what you get. But for me, because I've been trading personal funds for so long, like I've been trading my personal account for so long, it's just my preference. I prefer it. But these are 3 different prop firms that I think are really good to go with. There's Take Profit Trader. I would recommend also, if you are going to use any of these prop firms, please do your due diligence and research the rules that you have to comply with when you are trading with them, because they have rules. The difference when you're trading personal accounts and prop firms, when you trade your personal account, you get to decide your rules. You get to decide how you trade. When you're trading with prop firms, they give you the rules and you have to follow them in order to get paid. And if you don't follow them, they won't pay you. So Make sure any of these three that you choose, you are researching the rules that you have to comply with to be able to get a payout from them, right? So let's take Profit Trader, Top Step, and My Funded Futures. Another one is Apex, but I didn't put Apex on this list because people don't necessarily like them in the trading industry. They don't have the best reputation. I've never had problems with Apex, but they also don't have the best reputation, and so I'm not going to recommend something to you that I have heard a lot of traders have issues with myself, right? So these are the three, in my opinion, most reliable prop firms to go with. Then there's free resources. So I have a 6-month roadmap for futures and options. So if you want to learn how to trade futures and options, like in 6 months, you can just get this roadmap. I basically outline all of the things that you need to do, or the things that you need to research, or the experience that you need to get. Basically, give you a timeline how to learn in 6 months. I think it's a really good resource. I also include a lot of definitions for some of the key trading terms that you may not be familiar with, which is also really nice. Because I do think a lot of times beginners can get caught up in trading jargon. Like I'll say a word and you're like, huh, what's that? So it does have a dictionary basically at the end, or a glossary at the end, that you can use for a lot of the definitions for a lot of the trading jargon that, we say on a day-to-day basis. But if you want to learn in 6 months, this is a good resource to have. Even if you want to learn in less than 6 months, it still provides you the structure with the things that you need to look out for to be able to finish in that time. So it's free, good to use, good to have. And so now I'm kind of done. Like, I am kind of done explaining to y'all basically what futures is, how to get into futures, some of the tools that you can use. And so we're gonna play a Kahoot. And the winner of the Kahoot